Sanjay, the prime Nifty 50 losers for this week are strange though, but it's Sun Pharma, it is ITC, it is TCS and Infosys. Now, in a weak rupee environment, exporters should do rather well, but IT and pharma stocks they've also started underperforming.
I think Nikunj is very clear. The earlier defensives that were holding out are the ones that are cracking now. So it's not got to do with the last 3 or 5 rupees, improvement in the dollar and the earnings being impacted. What is bothering the market right now and what is bothering the market participants is the issue of liquidity, because 80 to 90% participants at this point of time are just protecting their portfolio, protecting the capital. There is a sense of nervousness and panic, and in most of these positions, people have made a lot of money, so they're cracking because of the gut. So it's like the last wall of defense that is falling. So it's really not got to do with earnings, or it's got to do with the currency benefits that may accrue to them because of the rupee dollar.
So Sanjay, what is the right approach to cash in on this panic in the market? Is it time to start bottom fishing because there are certain stocks which are quoting at cheap valuations, or do you think it's time to add on to the names which have already been doing well, the likes of IT, Select FMCG and Pharma?
I think it's time to add on not the likes of FMCG Pharma, but the likes of metals and others, which have been beaten down, beyond anything. The market caps in terms of what the capacities are, etc., what the competitive barriers most of these companies, having large assets have created, particularly companies with large assets and relatively manageable and lower debt. That's the place you want to be, because as soon as the growth will bounce back, that's where the maximum, bounce will come in. Just, a little bit of long-winded answer. I was reading a report by a mutual fund yesterday, if I recollect, it was probably Access Mutual Fund, where they talked about the, PE ratio of the Nifty or PE ratio of the top 100 stocks being totally deceptive. And we still haven't reached 2008 lows or 2008-9 March lows. But market cap to GDP, which is more relevant right now, is actually or very close to the lows that we saw when the panic was at peak globally. So it just goes to show that the broader damage to the market is much more than, in terms of earning multiples, etc., where we might say, in fact, most of the, devil's advocates would say at this point of time, the PEs are still not at sub 8 or sub, or around the 9-10 levels, which you traditionally see as the lowest in the Indian markets if you go back 20 years. But what is right now lowest and has reached the 2008 levels, 2009 levels is market cap to GDP. And that is what is relevant to look at if you want to take a call and starting to build a portfolio. Okay. Yes, I made a buy call early, but no one could game the currency, and that's what is really causing all this damage.
Sanjay, you just mentioned that there is a buy case for metals. So what is the thinking behind that call? Attractive valuations, under ownership?
I think more attractive valuations, not in terms of earning multiples, but I think phenomenal entry barriers, phenomenal, capacities that have been created in India by companies. One example I can give you is JSPL, Jindal Saw. These companies, for instance, by the way, I don't have any interest in them, so I can obviously talk freely without any disclosures. These companies today are trading at market caps, or in fact enterprise values, in which 5 times of that you can't create capacities and you can't actually manage to, build plants today, because the land laws, the raw material linkages, the fuel linkages, etc., now would take 5 to 10 years to do. So when the economy bounces back, and we're not really like, India's overweight and we're never going to bounce back 1 or 2 years later, we're definitely going to bounce back. We are a deficit country in terms of, metals, etc., these resources. So these are the places one wants to be. One has to look at companies with very attractive valuation in terms of, where the enterprise value of the end companies are, and what the earnings have been and what reasonable earnings can be when, things bounce back. That's the place I want to be, and that's the place we are looking to buy right now, and have patience, because, currency, etc., will settle down. What is really nerving the market is, like you correctly said, is the movement, the rapid movement, 2%, 1.5%. So you can't really adjust your entire calculations in your portfolio, as well as corporates with their debt exposure to anything right now. So that's the reason I find metal is a very attractive place to be right now.
Sanjay, given the way bond yields have been spiking up, would it be fair to assume that perhaps there are at least 2 to 3 more quarters of pain left for bank balance sheets?
I don't think so. I think the pain is towards the end of what one has seen. corrections are always a function of price and time. Price is over and done with. Yes, we may not do anything in terms of, market caps for a while till everything adjusts, till banks are able to restructure the portfolios. I will not be surprised if, like it's happened in the West, RBI might come out with some kind of measure that we already saw day before yesterday on HTM, etc. Plus, in terms of restructuring assets, restructured assets, RBI would come out with some dispensation, some relaxation for the banks in the next year or two, because ultimately the corporate sector also needs time to really bounce back. Given that assumption, I think the banks are not going to see any more price damage. Yes, we may see some amount of time-based correction that may carry on for a while, but price, I think, is done with.
Great answer, Sanjay, that correction could be time-wise and price-wise. Well, the value-wise correction, the price-wise correction is over. Sanjay, so what is the big trade currently? There are two trades. One, you hide into the deep value end of the market where value will rescue you. And the other trade is that you hide and buy into the quality end of the market where eventually institutional buying will rescue you.
I think, Nikunj, that's completely a function of your risk-taking appetite and your investor profile. What kind of investor are you? If you're an investor who is willing to take an X amount or extra amount of risk or substantial amount of risk, then I would go for deep value, because that's where 2x, 5x, 10x would come in the next few years. But if you're an investor who's conservative, who can't really handle volatility, risk or pain in terms of deep value getting deeper or deep value remaining deep value for a long period of time, then I would advise that you go into defensive, go into the blue chips where you will see a steady bounce back, and you correctly said, where you may have a huge amount of institutional money come in eventually. So it's more got to do with that. But if you ask me as what I would like to do, in terms of someone who's willing to take that extra risk for that extra return, I think I would like to be in deep value, which would actually kick up fast whenever growth picks up. So I think that's the equation I would go for, given my investor profile and the fact that I'm a little more glued on to the markets than what a normal investor may be.
Like from the Nifty 50 basket, anything which is looking attractive there?
Nikunj, I think out of the Nifty 50 basket, I think Nifty 60 is looking, I can find 60 stocks which are looking good. So you got to have the courage to hang in there and hold out the right stocks. So on a more serious note, I think I can easily identify 25 to 30 stocks from the Nifty basket which are deep value, in terms of large cap stocks, because deep value is a function of, are you willing to buy this penny stock? Are you willing to buy a large cap stock? And there is value in there. And in addition to that, companies which don't have too much debt in their balance sheets. In fact, I would happily buy, banks that are part of the Nifty at this point of time, because contrary to what people feel, I think banking sector as a whole will do well in India. Yes, there would be pain, like I said, time and price issues, what I just defined. But I think one would make substantial amount of money in buying some good quality banks at this point of time.
I was just coming to that, Sanjay. So would it be the likes of HDFC Bank, ICICI Bank, which have been a little more resilient perhaps, or would it be the extremely beaten down ones like a BOB or IndusInd amongst the Nifty 50, that is?
Aisha, very good question, because, we have this continuous debate over private sector banks which enjoy a premium to the, in the sector. But frankly, I would like to go for public sector banks at this point of time and not the private sector banks, because I think private sector banks haven't corrected enough, can correct much more, but public sector banks have been beaten beyond shape. In fact, the scare and the panic of NPAs in the public sector banks is beyond what actually is there. In fact, public sector banks, in my investment history, I've seen are much more conservative in terms of, lending, in terms of asset portfolios, in terms of provisioning. I'm happier there, at least at this point of time, given the fact that where the prices have collapsed.
The PSU banking space also, Sanjay, it's a very long list. So State Bank of India right at the top. One would argue that, Bank of Baroda and Can Bank, they are somewhere in the middle. And right at the end of the curve, you've got smaller banks like UCO Bank, Allahabad Bank, Dena Bank. So which end of the spectrum would you like to buy within the private banking, within the PSU banking space?
I think, Nikunj, I would really like to pick up 5 stocks, of which say about 30 or 40% I would like to keep in good quality small ones, which have a relatively clean portfolio, relatively, good management. One can easily make out from the top team as to how they've been running the organization for the last few years. And the balance, 60% I would go for the large cap marquee names such as State Bank, BOB, PNBs of the business.
The best trade is right now to buy the Bank Nifty. I mean, if you buy the Bank Nifty, you pretty much you can capture everything.
That's where the dilemma is, because that's what I mentioned. You asked the question, trade, yes. Investment, 100% I would say yes. Trade is a little risky, dicey. But of course, on the snapbacks, you make good money because they go like Nifty, like Bank Nifty yesterday morning was up 4% if I'm right. And then by evening, we were in the negative territory. So obviously, if you have the stomach for that kind of volatility, then trade. But otherwise, as an investment, I think it would be a good idea to go and buy a mutual fund which has a relatively good, bank scheme, a bank, fund which is there. That's what I would want to buy right now if I want to take exposure to the banking sector.
Okay, Sanjay, good chatting with you. It always is, and good to see you after a long time.
Thank you, Aisha.